to another episode of Always Up to Date. I'm Denise and this is Yahweh, and we are co-owners of Always Bookkeeping here in Edmonton. So how are you today, Yahweh?
Good. We have good weather and we had birthday cake from yesterday from
birthday
you.
Cake, yeah. It's always a good thing.
Yeah.
Perfect. So today we're talking about intercompany transactions between small businesses. So our quote is Jim Collins, author of 6 books. And the quote is, "A culture of discipline is not a principle of business, it is a principle of greatness." So our statistic today is from Intuit, who are the makers of QuickBooks. They did a survey of small business owners and quizzed them on some basic business financial literacy questions. For example, the role of the balance sheet or accruals, how to improve cash flow. So 82% of the respondents scored less than 70% on the test. So the story that we have is, your accountant advises that your partners and you should use your holding company. Now I have 2 companies that you have to file for, but you don't know why the intercompany accounts are not matching. Mm-hmm. So we get a lot of that, right? There's different companies involved and just how they relate to each other and what transactions need to go where.
And because now you have 2 companies that you have to look for, and they don't necessarily have the same year end as well.
Yeah,
so.
That's right. Yeah. So Yahweh, tell us what a holding company is.
So a holding company is a corporation that owns another corporation. So it has a stake on another corporation. Meaning, if you have for example, if you're dealing with a partner and you have that extra layer of protection, you will most likely have a holding company that owns the operating company, so that in that way your corporation or your holding company will be treated a little different than your partners. And the asset, if something goes wrong to the operating company, it doesn't necessarily direct all the liabilities to you and your partner. It might it gives you another layer of protection through the holding company that you own.
So what are intercompany transactions?
So intercompany transactions are the transactions that happen between your operating company and your holding company, or a related company. So a related company, it could be anything really, and a lot of people have mistake that if you own another corporation for more than 25%, that becomes a related company to the corporation you own now. So for example, the holding company, if you own the holding company 100% and it owns the other company, those two become related. If you for example own your company here and your wife owns or is a director of another company, that becomes a related company too. So intercompany transactions are the ones that happens in between those related companies, so those related companies are intercompanies.
And so what are some bookkeeping errors that can happen with intercompany transactions?
So some bookkeeping errors that could happen is, let's say they receive a deposit on the opco, and a bookkeeper doesn't know what the deposit for. Our normal reaction to a deposit is it's a revenue, right? So if it's an intercompany transaction, you want to make sure that gets classified correctly, because you want your operating company to match whatever the holding company is having with relation to what they owe to each other. Because at the end of the day, they're gonna have to declare a dividend to that to the holding company, and if that number is wrong, then you might get taxed or penalized differently based on that specific transaction. So it's very important that you match them all the time.
So what does it mean to have an asset or liability account for the related party?
So on the operating company's perspective, for example, if you do have a due to from account that's on the asset side, that means that the holding company or that related company is owing you money. So you have an asset because this is technically a receivable from the related party. So that becomes an asset account. But if it's on a liability, that means you owe that corporation money, which means that the holdco is contributing more to the operating company. Yeah.
Okay. So what are the common mistakes on handling intercompany bank transfers?
Yeah, so bank transfers, again, it comes to deposits. If it comes to an unknown account, normally it's a personal account that the bookkeeper didn't know that it was personal, and they didn't see that it was from the account of the intercompany, or sorry, the holding company as well. Our first reaction is if it's a transfer from a client, so you put it as a revenue, which you're going to be taxed on based on the sales, right? So that's one big mistakes, more common mistakes that happen during bookkeeping with regards to the intercompany transactions. Another thing is the expenses, because sometimes you will have expenses that the operating company will be paying for, but it's actually the holding company's expenses. You don't want to expense that in the operating company. You want to make sure that that gets expensed in the holding company where it's supposed to. So it's one of those errors too that you want to watch out for, because if nobody expends that, then that's a missed opportunity.
That's right. That's right.
Yeah.
I think too sometimes, like if there's a sort of a round larger number that goes out of the operating company to the holdco, and we don't realize that's what it is. Sometimes the mistake that can be made is that we think it's a shareholder loan. So then again, you're taxed differently, and instead of that going to the operating company, it's going to your shareholder loan. So like there's lots of mistakes that can be made with the
and sometimes they would for example, if you want to pay the shareholders, they would put the name in, but they don't know that there was a share structure that it should go through the holdco. So it's one of those things where the shareholder would get taxed personally because it was named to him and it was labeled to him directly as a person, as opposed to going through the holding co first.
So should I try and match all transactions for both companies?
Yeah, absolutely. If you have a lot of intercompany transactions, it's very important that you match it, especially on a monthly basis, because again, you want that to match all the time, because in the opco, when they do the year end, they want to make sure they want to look at that related company transactions or related party accounts, because that's when they decide how much to declare for dividends to those corporation. So if that's wrong, then possibly you're gonna end up paying more taxes for when you remove that from your holdco, because they put too much dividend towards your holdco. Or if you have a partner and the intercompany transaction is wrong, then it's not fair to the other person who has the error, right? That's so very important.
So how are the dividends treated if it's issued to a Canadian corporation?
So if it's issued to a Canadian corporation, it's tax-free. So the flow is if the dividends are declared to the opco to the holdco, it's usually tax-free until they issue the dividends from the holdco personally to you. So and that's another reason why you want a holdco, is that separate layer of protection. and another set of mechanism to flow through the income from the operating company through the holding company before it goes to your personal account. Yeah.
So is it a separate filing for each of the corporations?
Yeah, absolutely. So a holding co is although it's related, it's still a separate entity from you and your corporation. So it comes with another set of, depending on how it was registered, it's going to be, it's going to have a GST account, a separate payroll account if you pay yourself through that holding company, or you declare a salary from the holding company, and of course it's going to have its own corporate accounts, which is the corporate tax and provincial. Yeah.
And what benefits can I get from having a holding company?
I think we touched on it before. Again, first of all, the extra layer of protection. Second thing is that since you have a different year end from the operating company, it gives you a little bit of a mechanism to delay paying yourself, right? So if you have if you find that you have an overdrawn shareholder account and they have to issue a huge set of dividends to your holding company, then it kind of gives you that extra number of days where you can put money in to decrease that dividend to before you pay yourself, or altogether just keep that that dividend into the corporation and not take money out from you personally. So yeah, so it's a great advantage of delaying your personal taxes depending on what dividends or salaries are issued from your opco or your holdco. Yeah.
Great.
Yeah, so I hope you guys find that informative. We didn't go into much detail to related party because we are focusing on small businesses and small transactions. Unfortunately, intercompany transactions still happen with small businesses, so we just want to address the more common items that happens for those. For especially for Edmonton bookkeeping. If you do find it informative, please click like and subscribe. If you have any ideas on what you guys want us to talk about, please comment down below, and we'll see you guys next time on our next episode of Always Up to Date.